All new this morning, the markets are ready for another rocky day as investors respond to the Federal Reserve's indication to raise interest rates. The Fed chair announcing yesterday the position it will take to cap inflation to protect those really most vulnerable to rising costs.
We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
All right, so what's next? Well, analysts believe the Fed will raise rates gradually in a quarter-point steps beginning this March. So you might be worried about how interest rates could impact your finances and what you can do now to get ready. So you're not left asking, where's the money?
As we're seeing inflation rise, that is a signal to the Federal Reserve that something needs to be done.
Interest rates are expected to rise this year to combat inflation, but how will that impact your finances? The federal funds rate, which is set by the central bank or the Fed, influences the prime interest rate, which is what lenders use to determine how much interest you'll pay on credit cards, mortgages, and other loans. When the federal funds rate goes up, the prime rate tends to follow.
I think there's quite a bit of room to raise interest rates without threatening the labor market.
So what can you do now? Refinance your mortgage or private student loans at the lower rate. The difference between 3% and 4% interest on a $300,000 mortgage is $53,000 over 30 years. Now is also a good time to pay down high-interest consumer debt, like credit cards, since those interest rates change with the prime rate. And try to improve your credit score. Borrowers with higher credit scores get better terms. Pay down debt, keep your credit usage low, and never miss a payment.
So what got us up to this point? Well, in March 2020, the new pandemic pushed the market into a steep dive. The Fed quickly dropped interest rates to nearly zero, helping to support the economy and limit the recession. But 2 years later, consumers, they're paying more for everything, as you know, from food, clothing, cars, gasoline, you name it. By gradually raising rates, the Fed is hoping to accomplish that sort of Goldilocks economy, not too hot and not too cold either.